in China over the years. What did you learn from your trip?
I think I learned two things, David. On the plus side, I would say China's back. Other than people wearing masks, you would have no idea that ever been COVID. They're humming along, they're hard at work. We met up with a lot of startups and entrepreneurs and venture capital kind of people, and they're very focused on building their businesses. The first quarter GDP number is 4.5%. People say, okay, it's a slowdown from 7%, but it's a great number, certainly compared to our 1.1% for our first quarter. And so they're humming along. The flip side of it is that clearly they're a bit off balance, both by what America has done to them and the state of the relationship with the U.S., and also, frankly, with Xi, who came in with an economy that had really moved heavily toward market-based activity, market reforms, and he dialed a lot of that back. And now he's trying to walk it sort of back the other way a bit, but the Chinese don't really know where that's headed, or there's no transparency what to expect.
We tend to focus on the geopolitics, the relationship between the United States and China, but you make a really important point. If you're simply a businessman in China trying to make decisions in China, you don't have the certainty that maybe you thought you had before. And what does that do to their willingness to make investments, to take risks? Because you're not sure when the government may come crashing in, as frankly they did in the tech area.
Exactly. And so the problem was that a couple of years ago, when Xi decided that the tech industry had gotten too big for its britches, he also got onto this sort of common prosperity theme, which is fine, less income inequality. But then he started randomly picking on sectors like online education, which he more or less shut down in a day. And so it was very interesting for me to watch this. And so then Xi gave some speeches and kind of outlined what he thinks China ought to be focusing on, things like renewable energy, new technology, stuff like that, hard tech as we call it. And so as we talked to our investment managers, they suddenly pivoted. And they're essentially listening to Xi and saying, well, if he wants us to invest in A, B, and C, then we better go invest in A, B, and C and not X, Y, and Z. So there's a lot more trying to figure out what he wants and trying to follow it.
As you talk to your investment managers, are there some areas they think are safer in the sense it's less likely the government will get involved in that?
Yeah, I think certainly industrial. Like I visited a company that makes gears, very high precision gears. Their business is fine. They're a leading manufacturer. He doesn't care about who makes gears for electric vehicles and things like that. So sure, and then there's a lot of activity in things like robotics and so on, where again people feel very comfortable. This is where Xi wants them to go. Everything related to battery technology, anything to do with energy and climate, all great. Let's go there. But more careful about the so-called sensitive sectors. Anything involving content, the media, things like that.
You talked about growth in China, which is not what it was, but still, as you say, enviable for much of the world at this point. One of the things that we read about is that the nature of their growth has shifted from essentially an export-driven growth to internal, to developing their internal markets. Does it change the sorts of companies, the sort of investments you look at?
It's a great question. Yes, this is something that people sort of have suddenly started talking about, but it's been underway for a long time. China has been not just an export-driven economy, but an investment-driven economy, huge savings rate. And for a decade, everyone, including the Chinese government, has been trying to get consumers to consume more and create more of a domestic economy. And that is starting to happen. The implication of that is as investors, is that there's a lot more focus today on the domestic stock exchanges, the Shanghai Stock Exchange, the so-called A shares, where domestic companies that make things for local consumption tend to be listed, because that is what investors perceive to be China's future growth engine, and less emphasis on, for example, the New York Stock Exchange, where a lot of the Chinese tech companies are listed, because people are worried about where they're headed.
There was a time a few years ago when there was wild fluctuation in the Shanghai exchange, in the domestic exchange, in part because, as I understand it, a lot more of the shareholders really are retail. It's not institutional. And so you could have retail investors really move quickly. Is that still the case, or is it becoming more driven by institutional?
It's somewhere in between. Everything you said is exactly right. That's the way it was. Institutional money is now coming in, so the market is getting institutionalized. This is not a market in which I would recommend individuals go out and buy the index, for a couple of reasons. First, the one you said. Secondly, there are still a lot of state-owned enterprises inside of that exchange. And although they've actually done well lately, better in fact than non-state-owned companies, in general, we don't perceive them to be the thought leaders or the great engines of growth of the future. So a market like Shanghai is one where a good money manager can actually create a lot of so-called alpha, outperform the index because there's so much volatility and junk inside that index.
So as an investor in China, how concerned are you about leverage? We've heard a lot about really extreme leverage in the Chinese economy.
Well, certainly company by company, we don't invest directly in companies very often, but our managers hopefully are looking at leverage. I think leverage across the Chinese economy is a little bit missing the point in a sense, in that people are looking at the liability side of the balance sheet, but there's also an asset side of the balance sheet, which is they own a lot of stuff, including over $1 trillion of our treasuries. And so they also, I think, if you really try to create a balance sheet for China, you would be envious of that balance sheet relative to our balance sheet in terms of the level of the assets, because of all that saving that we talked about, the level of the asset accumulation that's occurred along with the leverage on the other side.
Steve, you mentioned the uncertainty, maybe some would call it even anxiety, about the U.S.-China relations, two largest economies in the world, and there are a lot of hostile things being said on Capitol Hill about China at this point. How realistic is not decoupling, because Janet Yellen, Treasury Secretary, said it's not going to decouple, but a movement in that direction, what that could do to the Chinese economy, but to ours as well?
Well, two things. First of all, I was really surprised for the first time in my meetings with the Chinese, our investment managers, that in addition to answering our questions, they had questions for me. They wanted to know about the Chinese-American relationship. They wanted to know what to expect from the Biden administration in terms of export controls. They are very off balance about the state of the relationship with the U.S. I think Janet Yellen's speech was excellent. I read that whole speech. There can never be a complete decoupling. We get all of our bicycles from China. We get all of our toys from China. You're not going to be able to resource those from other places. But yes, it's like, if you think of it as a spider web, the spider web is starting to disentangle a bit. The Chinese are very focused on the possibility or the desirability of trying to make more of their stuff outside of China, so that it's not, quote, Chinese anymore and would come into the U.S. more easily. So it's a bit of both, but we also have to recognize there's a cost for both economies associated with this decoupling. The coupling helped us have very little inflation over the last 10 years until recently because of lower costs. As you decouple, by definition, you're sourcing stuff in a more expensive way, and obviously the Chinese are losing business. So it is really a lose-lose. There's obviously good national security reasons to try to reduce our dependence on them, but nobody should kid themselves. It is a lose-lose.
One last one. China has been known for restrictions on currency, capital flows outside of the country. Last week on Wall Street Week, Larry Summers said one of the reasons we don't need to worry about the RMB displacing the dollar in reserve currency is because nobody wants to put their capital in there if you can't get it out. As an investor, do you take that into account? Is that a problem for you?
No, I don't think so. We can get our capital out, and yes, I mean, you can worry a little bit about what they could do, but I don't think that's a significant worry. I thought what you were going to ask me, and I would agree with Larry, that the RMB can't become a reserve currency. You can't have a currency that is managed and with capital controls become the world's reserve currency, and with a government that is so unpredictable. So I think probably the last thing I worry about is the idea that the RMB is going to displace the dollar.
I think that this analyst is heavily biased. I mean, my entire portfolio is, as you've seen before, purely in Chinese equities. So this is only in Chinese stocks, and even I am like concerned about China. This individual talks as if there's like no geopolitical risk, and that's really inaccurate. There's a massive, 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 massive political risk. I mean, it's extremely precarious right now. Almost daily there's tensions between the U.S. and China. I don't know what this person is doing. I think that, though, this is my opinion, but I think that this is highly not, I think this is not really accurate, because I mean there is huge risk in investing in China. I mean, even I am like really concerned about it. Every day I check the news all day long just to double check to see, hey, what's going on? Are they doing new tariffs? Are they easing? Are they not easing? Are they going to do another? You don't know what they're going to do. And so the fact that we don't know what they're going to do, I mean, that doesn't bode well for China's economic future. That's why I think the growth is at 4.5%, is that they've gone really political and they don't really seem to care, like Stanley Druckenmiller said. So we'll see what happens.